Hey Shane, how's it going?
Hey man, it's again, it's going better for me than it is for the stock market. So
Yeah,
another one of those days.
bit of a sell-off today. So I think right now SPY's down 3.8% on my screen. And for everyone watching, today is May 5th, 2022. But yeah, quite the market. I wanted to start off before we get into everything is I know there's some people out there that are certainly frustrated. It's been a choppy market ever since this year started. And the biggest thing is always to focus on risk management. So I just have this table up in front of us, but as you can see, the percentage losses on the left-hand column, once you exceed 25%, you start having to achieve returns like 33% and higher just to get back to even. So when you're in a market like this, it's time to just focus on guarding your capital, do risk management. And when times are easier to read and get in, that's when it's time to get aggressive. But right now, if you're starting to let that, loss side of the equation get to you, really got to focus on that.
Yeah, I mean, I was mentioning this, like, I think the reason we're starting here is because this is where we kind of left off last week, where we
Mhm.
had I think we mentioned ARC, uh, and the Teladoc stock that was, down 80% and then dropped 50% on its recent earnings to be down 90%. So, and I was saying, and I had the math right. It looks like I said, if you drop 80%, you need to make 400% just to get back to even. So, yeah, I mean, I think it's a good thing to keep in mind is risk management is the key. That's again, that's why we follow stops in our personal accounts, and certainly why we follow trailing stops in our professionally managed accounts for clients. So um, you can't guard against things gapping down. Sometimes things do drop, big on earnings, and you can't exactly get out at your stop. We call that slippage. But for the most part, if you're in a large cap stock, you're going to be fine, and you'll be able to get out, at or near your stop price. And yeah, if you limit the losses, you don't have to claw back as much. And the other big key is, like, even if you are down big, let's say you're down 30% in a stock, um, asking that same stock to go up 43% just to get your money back out is not probably the best bet. If it's down 30%, it's down 30% for a reason. It might easily go down, a lot more. And so sitting and waiting and saying, oh, it'll come back someday before I retire, it's like there's 100 other stocks in the market that are gonna go up 43% in the meantime while you're sitting there getting smoked in some dog. So anyway, I mean, I think those are the keys. But why don't we jump over to the SPY? You can just click it on your watch list on the right
Yep.
there.
And just for everyone watching, a change that we're making is now we just have our watch list over on the right here, so you can see the tickers that we'll talk about throughout the show. So let's jump over to SPY.
I think my list is probably a little different than yours, but that's okay. If I share my screen, you'll be able to see it. Oh
There you
no,
go.
you're good. I'm not. I know I was
Oh,
good with yours. No, I don't have anything to share. Yeah, I was looking at yours, waiting for you to say something.
gotcha. Okay.
What you
So
got? Are you on the weekly SPY chart there?
so I'm on
Yeah.
the weekly right now, and the only reason is that I was looking for the question everybody has: how far down could we go? And you never really know, but this is the level on SPY I've marked. Was we had that kind of post-COVID high where it ran up, failed, and it hit that level a few times, and that puts you right at 351. So if we were to measure that and just get an idea, how far down could that go? It's another 15, 16%.
Yeah, bear market territory, sir.
So that's kind of what I'm marking there. But let's go ahead and look at the daily here. And what I wanted to start off with is, what are you watching now? And here's what I see. So on the daily, we have come up to this level. I think it's 4 times. And in order to see that, you have to jump to an hourly. But look at this. So right under 430, we hit that on April 25th. And then, here again, there on the 28th. And then this was that Fed rally that we had. So we failed 4 times. So that level is definitely telling you something. I am not bullish at this point, not when you have a reversal like that. And this is what I'm watching. If we cannot hold this level at about 416, and clearly we're already through that, then I think there's just more downside. What are you
Yeah,
seeing?
well, just now, I mean, the market tried to bounce at the lows yesterday and failed, put in a new low from yesterday. I mean, for anybody who doesn't know or is watching this after the fact, that big green candle from yesterday was because the Fed came out and said they were raising interest rates by 50 basis points and unwinding the balance sheet, starting to unwind the balance sheet effective June 1st. So um, I don't think there was a whole lot of people who were like reading that as, wow, this is great, this is bullish, let's go buy stocks. I think what happened is some people were positioned for it to be worse, and they were forced to cover their shorts. And once that short covering rally got going, it squeezed a lot of other shorts out who had to buy. And then overnight, people digested what the report said and realized that there is not a single bullish comment throughout the statement or the conference, the press conference that Jerome Powell had after the fact. And I mean, there's nothing to be bullish about. There's nothing to be aggressively buying stocks about. And so actually, this would be a good time for me to maybe share the screen that I have up right now. If you want to give me that permission, Kyle.
There you go.
The last time that the last time that the stock market rallied more than 2% or more than 2.25% on a day where the Fed hiked interest rates was back in March of 2000. And so you can see on the screen right now that in March of 2000, the market made its high for the dot-com bubble, and then proceeded to drop 50% from there without, any real bounce. So, it took because it was 6 months of downside and a 50% drop from the last time the market did what it did yesterday. So, I mean, it's a small sample size, admittedly. Only one time in history has it ever happened, but that one time in history was not a very good outcome. Certainly wasn't anything to be bullish about. And there's nothing to be bullish about right now. I mean, buying stocks right now it's just a gamble, and you're basically gambling on, I don't know, I guess the market going up like it did last year when it had no fundamental economic reason to do so. And so right now there's just no fundamental economic reason to be long the stock market. I think you got to probably own some stocks just in case, you get some bounces and things like that. But to be 100% long, or as some people do, they borrow, they put all their money in and then they borrow margin against their portfolio to put even more money into the market. I don't think that's a good idea right now. I think I think it's obviously not a good time to be bullish. I'm super bearish. I'm still net short in all of my personal accounts. And it feels good to be net short on a day like today.
Yeah. And I wanted to hit on one thing. It is so common out there. You always hear, oh, when there's blood in the streets, you're supposed to go buy. Well, there's some clarification that needs to be made on that. It's great to buy in a sell-off if it's in the context of a larger uptrend. So if you're on a longer time frame and it's an uptrend, great. That's a time to buy. But when you have selling like you're seeing now and that uptrend is starting to fade, that's not a good time to buy. So, I think that's just too generalized of a statement, and it's about looking at that bigger trend. And, we're just seeing a lot of trend or support levels that are getting broken and market rallies that just get sold off. So this
Yeah.
isn't a time to get aggressive.
It's as you were talking, I was just realizing that this is a monthly chart. So I was wrong. This is like, this took like a couple of years to go down 50%. This was a several year. Let's see if I hover over. It doesn't tell me.
It looks
But
like
it was,
2000,
from
2003.
from 2000 to whatever. What day was this? This was now it was like October of 22. So yeah, you have most of the year 2000, all of 21, and most or of 02, and most of 01 and most of 02 before the market finally put in a bottom. And then you see what happened on the monthly is you got, a bottom and then a retest of that bottom, and then the market went up for a good number of years into the financial crisis, and then dropped right back again to these levels. Now, technical analysis is not magic, but this is what happens. People are looking at these levels. So when the market got back to these highs, it's not really a coincidence that ended up being the high. even though the mortgage crisis was nothing related to, the dot-com crisis, they weren't the same thing at all. But this is just human behavior. And so now where are we today? Well, we're way the heck up here. And so, I mean, ultimately you want to be long the stock market, right? I'm not a perma bear, but there's nothing to be bullish about right now. And there may not be for years. There may not be for several months. I mean, you don't know how long this stuff's going to last. The COVID deal, which is right in this neighborhood, it only lasted 3 months of downside before putting in a bottom and ripping higher. So you never know. But at this point, right, we're on month number 1, 2, 3, 4, 5 of downside already. And we're nowhere even near the 50-month moving average, let alone the 200-month moving average, which is what stopped the drawdown, back during the dot-com bubble. So maybe not exactly, but you get the idea. There's support and resistance levels all over the place, whether you're looking at a daily chart, a weekly chart, a monthly chart, or something totally different than that. So, so anyway, right now, this is the environment we're in. We're in a downside environment. There is nothing to be bullish about at all, but that doesn't mean you want to put 100% of your money in cash. It just means you want to carry a bit more cash than normal, and we are certainly doing that. In our elevate strategies, and I'm carrying more than 100% cash in my personal accounts by being net short the market. So
Yeah,
it's great.
and then I just wanted to, if you want to let me share the screen here. So back to this. So if we wanted to be bullish, well, where would we be bullish? So just for anyone wondering on that end, is we need to for sure break 430. Your next level's right up here at 436. But truthfully, we need a daily close up here over 458 for me to think that now it's time to start buying stocks. And you always have to remember there's plenty of stocks that'll be out there that when the S&P starts closing up here, that just sets the tone. So now it's a bullish environment. There will be stocks that still have great buying opportunities, but trying to jump in now and outguess this market is not smart. This is just a time where it's all about risk management.
Yeah, terrible risk reward to buy the market right here, trying to catch the falling knife, as they say. If,
Yeah,
for people who don't know, I mean, if a knife falls off the counter, do you try and catch it in midair, or do you let it bounce on the floor a couple of times before you pick it up? It's pretty simple, right? Which way is the way to not get hurt is to wait. And so there's no reason to be impatient or in a hurry to buy stocks. Again, there's nothing to be bullish about. And once the market turns back to bullish trend, you'll have the rest of your life to buy dips. There's just
absolutely.
no reason to be in a hurry. I see the 436 level, or the 436 level you have on there also perfectly coincides with the 50-day moving average too. So I mean, above 429, I might consider buying for a further bounce. Above the 50-day, I might consider buying for a further bounce into the 200-day. Anything above the 200-day, I might consider buying for another bounce. Because if we hold the 200-day moving average, I'd say the long-term uptrend has potentially resumed. So yeah, I mean, I think I look at it slightly differently than you, but the levels are they're a good guidepost that you have there. I think those make sense.
Absolutely. So why don't we go ahead and start going through some of these other tickers? The other kind of big index here is the Nasdaq. So this was just such a great chart before, but here, much like the S&P, breaking down, I see this as the next level of support. So 294. I've got nothing to be bullish about here. And I guess that would mean that we have, I think it's another, 7% lower that we've gotten here. So we'll see on this one, but that's just not a great looking chart. And I don't see any reason to be going long. If you're going to short it, you could wait for a bounce up into here. And if you're playing that game, but not very bullish. What are your thoughts?
Yeah, I was just looking at my Q's chart. It looks like, let's see, what's today? Today's May 5th. So from May 5th of last year, if we just measured, yeah, the Q's is down 5% from over the past 1 year. And Q's has erased all of its 2021 gain. So, you're sitting right on that level. It closed 2020 at 313. 313.74, and today sitting at what are we? We're at 314.70 right now. So it's
Mhm.
just kind of flirting with that level. Again, it goes just yesterday as a microcosm of all of last year. There was no fundamental reason for the market to go up, 25+% last year, whether you look at the S&P 500 or the Nasdaq. There was no fundamental reason for that, just none. At least last year, you had the Fed easing monetary policy. They were still buying bonds and calling inflation transitory. So those idiots have no idea what's going on. But that was like the one reason that the market was able to continue powering higher, even though earnings were slowing and growth was slowing all over the place. The economy wasn't in very good shape. I mean, it's all ridiculous. So I don't, how much further could this go down? Who knows, man. The Nasdaq is in bear market territory. It's down 20%, more than 20% for the year so far. And these Apple's down 5% today. Q's is down what, 5% today too? Is that right? I think, yeah. Oh yeah, on the watch list, down 4.5. It was down 5% when we jumped on this call. It's funny, by the way, how every time we seem to jump on a call, the market rallies while we're talking. Maybe we should do people a favor and talk longer.
Yeah. It's funny that it's important to point out to people when we draw these levels, this does not mean it's the bounce area. All that is a likely area of support. So if I was going to buy it, that's where I would buy it. But we easily could break through that. We could come back down all the way down to the COVID low down here at 170. I mean, who knows? But these are just likely consolidation or bounce zones.
Yeah. And again, I don't buy things that are falling. Like I don't have a low end of my range where it's like, if it goes to this low end, I'm going to buy it. I don't do it that way. I would rather buy the momentum. I'd rather buy when it crosses above a range, right? When I say, okay, this thing's actually going up, I'm going to go long. I said it last time, I don't pick bottoms. I don't pick bottoms. That is not something I do.
When you talk about that, so the sectors that in the market are doing well, so energy, consumer staples, materials, utilities, those ones are in a positive trend. And those are the ones that you want to be, trying to actually buy, because you're not picking a bottom, you're just getting at a nice little pullback and an uptrend. But, for now, let's go ahead, take a look here at oil. We always take a look there, but nothing's changed here for me. Looks like a little sell-off today, but again,
yep, fake breakout today.
Yeah, you can't have a big move like this without some consolidation. So still bullish, but I think it'll just take time, and got the arrow pointing where I think it's going.
Yeah, today's candle is a little unnerving. I mean, I think I see what you see here too, but if that candle holds that way and it doesn't kind of try and get back to the highs that it saw this morning, I don't know. I mean, in the short term, I think maybe a little bit more downside. I would have thought I would have thought it ran today. I'm surprised it didn't. But whatever. The trend is definitely higher. I wouldn't bet against oil right now. I certainly wouldn't be shorting it. And no. XLE looks good too. So we did trim some XLE in our book into the close last night and at the open this morning. If you want to just tap on XLE. See that red candle looks that today's candle looks super bearish to me. That looks like a false breakout and reversal. And the funny thing is I don't know, just to remind folks, like as long as oil stays at 100 a barrel or more, these guys are going to do very well. The XLE, the energy sector, like, this is the Chevrons and the Exxon Mobils of the world. And with oil at 100, they're going to make money.
Absolutely. With XLE, when you talk about market breadth, every single stock in XLE or the energy sector is trading above its 20-day moving average, 200, all that. So you've got broad participation, which I really like. But, I thought this was interesting. I'll just zoom out quick. But we're kind of, could go all the way up here, but we're just in the top area. So on a weekly chart, I'd like to see a pullback if I was going to put new money to work right now, but certainly bullish XLE. But when you zoom out like this, just on a weekly, you kind of see that we're up here where, we've had that high they put in, this one there, could certainly keep going, and who knows how high it'll go, but I definitely want to be picking my spots if I'm putting new money to work on this one. And for sure you want to make sure you know where you're getting out. So,
Yeah.
you go on like a daily, I'm definitely putting a stop at the very least right here in this kind of 72 level and just keep following it up. But after today, I think we'll see a little bit of a consolidation. I think it's just, we need it just to let everything kind of slow down before it goes higher.
Market trying to bounce as we're speaking. So we'll see. We'll see.
And then, oh, here's gold. This is, I mean,
Heartbreaker.
we were pretty clear last video, but it's just not great. You
I
had
think
this.
I said last week that I'd rather be long oil than gold.
Mhm,
I'm pretty sure I said that. I think that's still probably true.
I do, but you had this level that we put in some support here, right here, broke down through it, came back up, and then just failed again today. Gold, hey, it could go higher, but why be going after a coin flip? There's just a lot better trades out there.
Yeah.
And now here's
Ooh,
10-year treasury. I mean,
solidly above 3%. Game over, stock market.
look at
Game
that bullish.
over.
And we're coming, I marked this level and you and I both did. So 3.15% on that. There's resistance there. If I were going to bet, I would think it hits that, sells off, consolidates, advances higher. But this is, if I was long the interest rate, I'd be taking a little profit off the table right here. But
You would? I wouldn't. No way. I'd be trailing that sucker. What is the mortgage rate doing? If you just start typing, you don't have to click anywhere, just anywhere on the screen, just start typing mortgage. That one, the second one on your list. What's that looking like? Oh, we got a little pullback. 5.10 is the mortgage rate.
yeah, it's not a great time to be buying, but you always hear from most real estate agents, relatively speaking, and they're correct, is that historically that's nice rate. People were buying houses for 18% back in the 80s. So
Yeah, it's a historically low rate. You want to hear like I think we're in the beginning of a new housing bubble. It's pretty wild what's going on. But I was reading something this morning. Hold on, I'm gonna find it here. In Florida, I think it was in Nassau County, which is Jacksonville, Florida. There are 1,148 real estate agents. Okay, 1,148 in Nassau County. Guess how many single family homes are currently on the market?
no idea.
Just come on, just the number.
I'd go with what, less? I know it's a competitive market. So
it's less.
500.
193. 1,100 real estate agents, and there's 193 houses for sale. Crazy, crazy times, man. It's totally crazy. But anyway, the funny thing is so like last time there was a housing bubble, it crashed and burned in 2008, 2009, right?
Mm-hmm.
The first mention in the history of the universe of housing bubble was in 2002, when Dean Baker noted it in a paper for the Center of Economic and Policy Research. Economist Robert Shiller, who does the CAPE ratios, he warned of the possibility of a housing collapse as early as September 2001. So he was 6 years early, which means wrong, but ended up being right. If you say something every day for long enough, you'll end up being right eventually. But it's so I think we're in the beginning of a new housing bubble. I don't think we're quite to the end of it yet. I think it might still continue because supply and demand, even though rates are higher, like supply and demand is so out of whack. There's just not enough houses and too many people want to buy them. So we'll see how it plays out. But houses can keep going even higher than where they are right now, despite a rise in interest rates, which is hard to imagine. But I think it's the way it is.
Absolutely. So something else, but so the question now is, well, what sectors of the market are good? And that's the thing. There's always a good sector, a good stock. I'll just click on it quick, but XLE or energy, and I'll go to a daily chart. But XLE, like that one, we kind of already talked about that. Here's consumer staples. That's a bullish looking chart. You could, if you're shorter term, you could put a stop here at, was it 75, and not too bad entry in this region, but that is a good looking chart.
Yeah, I mean, it's down 5 or 6% from the highs. So I mean, it's kind of starting to roll over. So I don't know how aggressive I'd get with buying it, but if you have to be long something, like I'd rather be long that than technology. It's down 5% in the past, month versus down 20%. So
Yep.
if you have to be long something, I think staples are a decent play. And I think the dip down to the 50-day moving average is probably a good entry point if you think it's going to continue going higher. We talked about this. We've got a lot of staples in our value strategy, and been looking at just kind of selling call options on those, on like Coca-Cola and Hershey and Procter and Gamble, because again, I'm not looking for staples to crash, so I'm not going to go sell our positions in staples. But I think the rate at which they've gone up is probably going to slow down a little bit because the whole market needs to come down. So we've been looking at selling call options against our staples holdings, but at the same time, we're looking at adding the XLP to our growth strategy because we need to maintain some stock exposure. But again, like I said, if you've got to be long something, might as well take a look at the XLP.
Absolutely. And, just back to what we started this whole thing with, trying not to lose those large amounts. If you have just a small return, but on something that has a higher probability going higher in an environment like this, that'll certainly help you. You can always get more aggressive later, but right now, these are the sectors that, they're holding trend. So here's materials where large run up, we've had this consolidation, and to me, that looks like a bullish chart. And much like, consumer staples, here's another point where you can kind of get in here, risk off the lows of these candles, and that's not a bad place to get in. And then the last one's just, XLU or utilities. And this one, just Shane, you and I have talked about this one. Makes no sense. Usually when you value utility companies, rising rate environment is terrible, but the trend keeps going higher. I would cautiously get into this one. This is one where, technicals, hey, maybe the trend's going higher, but with the rising interest rate backdrop, this is not a place I want to be putting.
I'd rather be there than bonds. That's
yeah,
for sure. Yeah, and I mean, it's had a 7% pullback for utilities is meaningful. At the lows of that candle a few days ago, it was down 9.8% in, not very many days. I mean, call it, a little less than a month, I guess. So from 4.8 to about 5.2, yeah, a little less than a month, it was down almost 10%. That's a meaningful drop for utilities. It doesn't usually happen that fast. That much of a drop. So if it does resume its upside, this is a good entry point. Again, to buy here, put a stop maybe at the 200-day moving average. You're only risking 4%. At the same time, it's probably only gonna, if it goes only back to the highs, you're risking 4% to make 8%. So a 2-to-1 trade, not terrible risk reward for a utilities sector, but not the kind of risk reward I would be looking for in my personal trading account. So XLU is one we're looking at for as a position in our value strategy, because again, we have a ton of cash right now, and so we're looking for opportunities to put it to work in something where the risk reward is at least in our favor. There's a lot of things where it isn't. So,
and one thing too for people watching is on these sectors. So I have the tickers over here, XLE, XLP. So there's always a couple ways you can play it. You can either just buy the sector ETF, and it charges a little fee, but it's pretty small, and it keeps you from trying to pick, what the best stock is. XLE, for example, trying to get what is the best energy stock. They all look the same almost. They're extremely bullish. You can just
I have an opinion on that. EOG is the best energy stock. If you're going to pick one, buy EOG. It's the best one, most efficient, best management team. It's awesome.
Shane has spoken, so there EOG you go.
Is my go-to.
I haven't gotten too lost in the weeds on those ones, so I don't know them, but I did pull some tickers up here. I'll just throw a couple up, that I thought these were great. I should just click on it. So ADM, Archer's Daniel Midland, they're commodity related. As we know, commodities have gone up quite a bit, and it's just sitting at a point right now where the risk reward here, I mean, shoot, you could get in today, put a stop just below this high back here that was set March 8th. And you got pretty nice risk reward. You're risking almost less than $1 to make, shoot, $10.
Yep. 10 to 1's good.
So I like
It's not a
that.
bad trade.
You know, Costco is another one on there. I think the other one, I'll just flip through these quick. Costco, you know, decent today. It's making me a little nervous, but the trend's still there. And then I think, you know, Dow, I thought Dow was nice. Look at this. You had this huge basing pattern, came back up, kind of retesting it with this level here. So I'll just draw a line, but you had this high set there back in, what was that, April? So I think that's risk reward. Again, put a stop below these lows and you got this really nice base that's got some upside, but you can also just go with the sector ETFs on these. So, you know, I researched these for a couple minutes. That's the beauty of technical analysis. I don't have to know everything about these companies, but what I do see is a positive trend.
Yep, Dow is one that we've got in the value strategy, and we actually sold covered calls against it. So I'm looking for it to hopefully pull back a little bit because I think we're at 67.5 is where our calls are. So I need it to drop maybe back to the 50-day moving average between now and the June expiration of options, which is like, I don't know, June 20th maybe. So that I don't have to sell our shares. But again, you know, that's why the beauty of covered calls is like we bought Dow, I don't know, you know, February, something like that. I don't know, like one of those low points. So, I mean, say we bought it at, I don't know, let's say we bought it at 59 bucks even. Well, if we have to sell it at 67.50, you know, that's, we get to keep the option premium and we sell the stock for a small gain, 5-10% gain. Not bad for a consumer staple stock.
Right. And that'd put you, so right now, if you got in down here, that's up about 20%.
Yeah, not
Pretty,
bad.
not bad. So
I don't think I quite got it that good. I think we're probably a little bit higher, but you know, no big deal. I mean, we bought it for a reason because it was trending higher and holding the lows. I mean, just look at it just keeps putting in higher low, higher low, higher low, higher low, higher low. I mean, I don't know about going back that far, but yeah, recently it's marching higher. 50's crossed above the 200-day. I mean, it's a good play. It's a good value stock. Pays a dividend of 3.97%. You know, that's what it's for. It's not a growth stock. It's not something that you buy to make hundreds of percent return on. I don't know that it's like a trader's stock because it moves pretty slow. The ADR percent's only 2.5. So on average, it moves about 2.5% a day. It's really not, you know, nothing too exciting there. When I'm trading stuff, when I'm buying breakouts and selling breakdowns, I want to trade things that are moving 5% a day. You know, because at 5% a day, it takes you 4 days to move by 20%. At 2%, it takes you 10 days to move 20%. So I like to trade things that move a little faster in my personal accounts.
Yeah. And, you know, if we're talking about that, so this is just the poster child, I think, of that ARK. They bought all the fast moving stocks. What they didn't do is implement a risk management plan. No. So we've talked about this one here, but I just drew the lines. So we've got, you know, down here, excuse me, down at 50, it broke every level of support I can even go back to. So this was kind of a prior high that it was setting all along this, you know, area, kind of pre-COVID, broke below that. Now there's no support below it. So here's one where you want to talk about fast moving stocks. It's like, well, yeah, it's a fast moving stock or number of stocks if you just went with the underlying, but now is just, it's not the time unless you're a seasoned trader and you've been doing this, maybe you're playing the short side, there's still 35% downside to the next level of support. So it's, you know, if you're seasoned, this is great, but if you're just a long-term investor, these names we're going through, you know, ADM, those ones, hey, they don't go up a ton, but the risk reward right now, it's a lot better to do that and let this all settle and resume some nice trends.
Yep. I'll tell you what, I don't know how much time we got left on this one.
I think a couple more minutes so we can wrap up here.
All right, well, check it out. Right before we jumped on the call, I actually made a trade, so maybe we could talk about that real quick. I have no idea how this is going to work out yet, so we'll have to check in next week and see if I made money or lost money. But
Sounds good.
let me share my. I'm going to share my screen so you can stop yours. I got to find my Zoom window. There we go. So I bought wheat. WEAT is one that I bought here recently. I've tried this before. I was in it for a while during this move here, but I haven't drawn any lines on this yet, so y'all can see what's going on. But from here to here, first we have the red, the red line, which is the 50-day moving average expanding away from the 200, and we've got this. There was a massive run up from down here. It was up 63% in a week or so. I think mostly due to Russia invading Ukraine, right? That was right during that time where that started to happen, and I guess Ukraine produces a fair amount of wheat for Europe, and so those people are going to now come and shop in the United States. And so what I see here is just some consolidation after a really big run higher, and a very clear breakout today. And so I had an alert set in one of my systems for when it broke through this level right here. And so during the day today, it broke through this level. And so I bought wheat just before jumping on the call. And I'm going to put my stop. I'm going to put my stop, or it's already entered, basically right here about the lows, maybe just under the lows of the day. So I'll make that one orange, I guess. So my stop will be, 1074, call it, and my cost was right around 11. So I'm risking 26 cents to, if it goes back just to its all-time high, to make $1.69. So not bad. Risk reward 1.69 divided by 0.25, call it. 6.76 times your risk on that trade, and there's no reason that it has to stop right there at the recent highs. Just look at natural gas, which recently broke through its highs, so it could go much higher than that. But the idea is to keep the stop super tight, so I'm risking very little to make potentially a lot. And if as it gets going, I'll probably move my stop to the 50-day moving average if that keeps trending higher, and that way I can lock in some profit. So that's a trade I made recently in the personal account. It's not the kind of thing that I would do with clients' money. We unfortunately can't act that quick. I don't want to be a day trader. I don't want to take people's retirement assets, which they've entrusted us with, and do risky trades where you have to be very quick to sell. A lot of in and out, lots of trading going on in the personal account compared to what we do for clients. So that's just if you guys are out there trading on your own, this is the kind of pattern that I personally look for. This is a very good one to me. And so I went half size to begin with, and if it keeps going my way throughout the rest of the day today, I will add the other half.
Sounds good. Well, good luck with that trade. I think it looks nice. Like you're saying, uptrend, you've got a consolidation, and now we broke out. And what is that? 6-to-1 risk reward. That sounds great.
A little over 6. Yep.
So awesome. Well, we'll certainly revisit that trade next week, see how it's coming along. And yeah, thanks for taking the time today. And we'll see how this market shapes up. But yeah, I think more downside today, but it's always fun kind of watching when it goes down 3+%. So we'll see.
Yeah, it's a gnarly move. I'm super bearish. Again, if it wasn't clear at the beginning, I don't see any reasons to be bullish about anything. Buying wheat is the only thing I'm long in my personal account, and we've been actively raising more cash in our client accounts, since we talked last time, and even so far this morning, we trimmed some of our long positions before the market really got accelerated to the downside. So, yep, now is a time for protecting capital. You'll have the rest of your life to buy dips when the market finally shifts back into a bullish trend, and we're a long ways from that.
Absolutely. So awesome. Well, Shane, take care, and we'll see everyone next week.
All right, thanks, Kyle. Later.